Oh, hello. That's right. We're talking about Disney stock today. We got Disney here. Just reported earnings after hours. Stock's already up a solid 5.5%. So we're going to take a look at these numbers and see what's going on. If you looked as far as expectations were concerned, obviously there's a company finally expected to go into the negative in terms of EPS, which is, it's a rare sight for them. You don't see it too often, but just due to everything going on, they were expected, to post a pretty bad negative EPS line here and see revenues declining around 25%. So let's take a little peek. See. Okay, pop-ups. Look at this, baby. So Disney posted a non-GAAP EPS of negative 20 cents. Beats by 45 cents and a GAAP EPS of negative 39, which is a beat by 56 cents. So honestly, all things considered, it's a massive beat, really, as far as the profitability line is considered. But still a negative line. I don't think that's at all unexpected when you talk about really majority of their business still during this quarter not functional, as in the park segment is really most of their business. Not unexpected to see big profitability hits, but a revenue of $14.71 billion, down 23% year over year, beats by $610 million. I think that's pretty impressive. I do give them credit because I talk about the park segment as really 50% of their income for the most part as far as revenue is concerned, and they've managed to, with very, very limited capacity, show only a 23% decline, and I think a lot of that is because Disney Plus has 73.7 million subscribers versus the consensus of 65.5. Holy crap. That is up right around 15 million of what it was last quarter. So that's incredible numbers. And I told you originally when this rolled out, I was thinking 100 million. First I said 100 million by the end of the year. But it might have been a little bit aggressive, okay? It was an aggressive estimate. I don't think they'll necessarily reach that, but I do think they'll definitely reach close to 80 million by the end of the year, which is quite incredible. Quite incredible to think about a service that just launched this year. And I think there's many reasons why it'll bump up even quicker. And I think it's because of a really increased amount of new content that's going to be coming on in 2021. I think it's going to be a big year for Disney Plus, and that really is the future of this company. So where you see parks failing, and they might for a little while. I mean, we're talking still probably another half year before that. Obviously, there's hope with vaccines, and then we could return to a sense of normalcy. But until then, Disney Plus is going to have to carry. And then once the parks recover, Disney Plus is just the icing on the cake for this company, and they're going to be booming with 73 million subscribers, already massive numbers. ESPN Plus subscribers of 10.3 versus 9.19 consensus. It's a very, very big increase there, too. You're talking about sports came back, which is pretty massive. So with that, they grew subscribers around 2 million just on ESPN Plus alone. Pretty crazy. Revenue by segment, media networks, 7.21 billion versus a 7.68 consensus, or versus 7.21 billion versus a consensus of 6.86, I should say. Parks, experience, and products was actually above consensus at 2.58 versus 2.23 expected. Pretty actually impressive. Studio entertainment of 1.6 compared to 1.98 consensus isn't unexpected, because really what movies came out that they could claim out of the studio entertainment. But the really, really good number here is the direct-to-consumer. I mean, direct-to-consumer international is 4.85 versus 4.6. This is slowly but surely, well, I'm not even slowly, this is quickly becoming the largest aspect of their business. It really is. And that segment obviously contains the a little bit of Disney Plus. And I think absolutely, if you're talking about midway through next year, I bet this does overtake this as the biggest portion of this company. And that's really exciting if you're an investor in this company. And I think that's why a lot of people are buying in. The numbers themselves don't look too good, but I think that's why the stock's up so much after hours. As we look a little bit into extra stuff right here, which we love looking at extra stuff. Continuing operations swung to a loss of $580 million from a profit of $1.23 billion a year ago, though expectations were for $854 million loss. Yeah, parks and experiences. I mean, used to be the biggest segment, down 61%. It was right up there, tied with media networks for biggest segment, and now it's down 61% year over year, and even studio entertainment down 52% year over year. Yet, with the direct-to-consumer up 41%, they actually were able to find a decent middle ground there and only decreased by around 23% in terms of revenue. So I think that's pretty impressive when two of your biggest segments, studio and parks and experience, were both down 50+%. I think it's pretty okay that they only saw a 23% decline, in my opinion. So operating income by segment, again, parks and experiences was a $1.1 billion loss. That's just it. That's it for you. And direct to consumer and international was down, was a negative 580 versus a year ago 751. So there's good stuff here to talk about. As they grow, they're gonna relatively quickly, I think, grow this into a profitable portion of the business. But right now, it just isn't, unfortunately. Streaming is a costly business for most companies. You see how long it took Netflix to get profitable. Disney's going to go through that for a little while. Then they're going to turn to, I think, a profit machine in the future. So, definitely be looking out for that. Definitely look out for that. So, yeah, Disney Plus, massive stuff. Remember, they said... I believe they said 50 million by 2024. Oh my gosh, it's already here. Son of a gun. So let's look at the press release. I'm pretty excited. That's all I can say. These are some good numbers, and I do think next quarter coming up is going to even be bigger because you're going to see even more growth. Q1 is going to have some big growth in the direct-to-consumer category because normally over this Christmas period, it's where you're going to see a lot of people signing up for Disney Plus. You're going to see it more than usual. It's going to be pretty exciting. So, I think this is something that is, it's incredible to say this because they give a year end here because it's obviously the end of the full fiscal year. Revenues this entire year only declined 6%. I mean, does anyone else find that absolutely bonkers? Only 6% decline on the year. Oh my gosh. I don't know. That's something that I find quite incredible. I mean, yeah. The net loss, though, pretty crazy. $2.8 billion lost this year versus last year. They gained 10.4. So, 10.4 billion. So, again, that's a $12 billion difference there. But I just think that revenue number is pretty crazy. Only seeing a 6% decline. It's not bad. 6% decline year over year is not bad by any means. Yeah, I mean, what else do you want me to say? I mean, that's some pretty wild stuff. Really, that is the case. Here's some more details as far as the cost and everything going on as far as the park segment and what they expect. So nothing super crazy. There's not any major announcements here that I noticed at all. So nothing's too crazy. I do want to go into the revenue breakdown by year end, where you see Park Studios saw a 37% decline year over year. Pretty ugly to see that, but it's not unexpected at all. They were completely shut down for 5 months. Media networks actually rose 14% year over year. Studio entertainment, which, not shocker, most studios were shut down and there weren't really many movies being released, down 13%, and then direct-to-consumer and international saw an 81% growth to nearly $17 billion this year. Just an incredible number that you're going to see pretty well continuously for the next few years, rising over 50%, in my opinion. So I think there's a lot to go on for this company. They're offering me quite a bit. I like what they're doing. It's impressive. It is impressive. It is quite impressive, even as far as the media networks. They'll talk about both cable and broadcasting. And obviously a lot of this is 21st Century Fox assets, and ESPN's in there, sports. Overall, though, you see growth here, which is pretty exciting. Cable networks grew 11% this quarter, if you're comparing year over year, and broadcasting grew 10% for the full year. Cable was up 9% and broadcasting up 25%. Pretty good numbers. Pretty good numbers. Parks and Experience, obviously, you saw ugly stuff. Disneyland Resort and their cruise line were closed for all of the current quarter. Are you kidding me? Though, so literally, I think it's quite crazy. Again, you saw a 61% decline, which makes sense because literally for the entire quarter, they did not have Disneyland Resort or the cruise line. Holy crap. Shanghai Disney Resort reopened in May. Walt Disney World Resort and Disneyland Paris reopened mid-July. And Hong Kong Disneyland Resort was open for about 2 weeks at the beginning of the quarter, and about 1 week at the end of the quarter. So, all of our reopened parks and resorts operated at significantly reduced capacities. Not a shocker, and obviously a lot more in terms of safety protocols, which cost them quite a bit. Yeah, quite a bit of cost there. Direct-to-consumer is obviously the major thing. I would like to mention here. Pretty crazy stuff. The improvement at Hulu was due to subscriber growth, which we love to see subscriber growth for Hulu. I think they'll go into this. Yeah, they do give me subscribers here, which is pretty freaking cool. And again, there is no year-over-year comparison for Disney Plus, but you see 73.7 million subscribers, crazy. ESPN Plus is up over 100% year-over-year, 10.3 versus 3.5. And even freaking Hulu, if you look at total Hulu, 36.6 billion, 36.6 million subscribers versus 28.5, which is a 28% increase year over year. Now, the thing I really want to point out is obviously big growth in the normal standard VOD category, just your basic Hulu plan where you get to watch obviously pre-recorded stuff. 32.5 versus 25.6, 27% growth. But this live TV is a big thing, and I think it will be future. As you see people cutting the cable, so to say, cutting the cord to their cable program, they're doing programs like Hulu Live. Hulu Live. I don't know why I said it like that. So 4.1 million versus 2.9, 41% growth. I think this is a number you'll see continuously grow. And it's really good for this company. It really will amount to a lot in terms of revenue because this is a $67 service, something like that. I want to say 69 just because it's 69, but it is pretty crazy stuff. Yeah, pretty exciting stuff. Average revenue per user also in that live TV number was 22% growth year over year. 22% growth. So really exciting stuff. And for Disney Plus, it's $4.52. So yeah, this live TV won $71.90 per user, which at 4.1 million subscribers, that's a lot of money. So really cool stuff. Really cool stuff. I like to see that. Other than that, I do want to look obviously at the balance sheet because there's a lot of expenses, and you don't know how this balance sheet got affected by it too. We got to scroll down a decent bit. Don't be too afraid. It's just a normal scroll down. It's kind of small. We'll zoom in for you. They said the same thing about my will, unfortunately. Oh, I wish. Okay. There's a comparison of a solid year-over-year comparison. We love seeing that. Total current assets is $35.2 billion versus $28.1 billion. So a growth around $7 billion in terms of total current assets. Total assets in general of $201.5 billion versus $193. So good growth there. $7 billion growth in assets. Now, obviously, the question is, how much does liabilities grow by? When you see a net loss, it's concerning because likely they've raised capital. So, if you look overall, total liability, total current liabilities of 26.6 versus 31.3. You don't like to see that, but then again, you love to see that, but then you look further down and you see where they make that up. Long-term liabilities rose as well as borrowings rose. Again, they raised capital. So that really did hurt stockholder equity by a decent bit. Total stockholder equity at $83.5 billion versus $88.8 of a year ago. All things considered, going through an entire pandemic year, I'm not too upset with how the balance sheet looks there. A decrease of around $5 billion on that balance sheet isn't scary as far as equity, but they actually grew the balance sheet as a whole as far as what's on it. I just don't know if I'm a huge fan of people that might say it's not fair. I think it's completely fair that they shrank the equity by around that amount. I don't think it's crazy. 88.2 versus a 93.8. Again, this is relatively decent numbers here as far as stockholder equity is concerned, and I think it's good. They definitely outweigh their deficit quite a bit. Hear me out. I'm still bullish on Disney, and you've probably heard that through this, and it stems from that streaming service. I really think it does, and what they can offer. I don't think this company is trading at a ridiculous multiple either, because revenue's still going to be over 60, probably 60 billion for the year, if we're being fair. Let's see, what was full year revenue? I was just there. I need to check that real quick. I'm not gonna sneeze. I'm not you. Look here. Look. I didn't zoom out. That was you. That was rough for me, by the way. Total revenues, 65 billion for the full year, trading at a PE ratio of 244. I don't think it's that egregious. That's only really 4 times what they're actually making. And I think it's only going to be a number that increases next year. Next year is going to be a very big recovery year, and they're also going to see continued flourishings from Disney Plus. So I hope you enjoyed this one. I'm buying Disney stock still. Just saying.